chance to say.
I'm doing well, all things considered. Looks like we had some spicy headlines over the weekend, but I don't think the markets are going to care in a few minutes. Tom, could I actually add something on there? Dr. J sent a note over. His crash course is specifically designed for someone in their 40s to 50s who's built up a nest egg through traditional investing, but now wants more control over their portfolios. I think that's a lot of our listener base right now. So be sure to check that out after this first call today.
All right. Well, with a lot happening over the weekend, Chris, we got to get right into it. But before, just so people have an idea, they're getting like early indications. I thought they would open down tonight on kind of the tariff news. I don't think that it means as much as it used to, but it looks like right now they're looking down about 20 in the S&Ps, maybe more. They did sell them off about 8 to 10 handles on the close. And so there was a nice little sell-off of the S&Ps on the Friday afternoon close. And it looks like tonight, right now, they're calling them down right around 20 handles, and we'll see where the NASDAQ opens as well, but a little bit lower today. Does any of that surprise you or no?
Not at all, given the news over the weekend. And when we look at, the proximal indicators that we have, IG has weekend Wall Street, but it's a very thin market. We're looking at what, down 0.3, 0.4%. Figure that takes you back down to the Friday low 62.75 or so in ES. But this has become a game of boy who cried wolf, right? The market is... how can you have a taco trade unless the market panics, and the market can't panic unless Trump chickens out? So it's like this one big Ouroboros, a snake eating its own tail. Volatility is low, though, Tom. I mean, the way that I'm playing this right now is looking for a squeeze higher this week. I've also started to lay into some longer dated puts because they're pretty cheap right now.
Well, you're going to have a chance to sell some. You're going to have a chance to sell some at better prices here because they look like they're opening down. Yeah, just about 20. Well, I thought 20, but really 27th. Well, now it's 32. So it's pretty decent size down opening, down a little over 30 handles in the S&Ps, down 125 in the NASDAQ, 200 in the Dow, and 15 in the RUT. Bonds up 2, notes up 4.5. That's a pretty big move in the notes. And gold up 19, 20 bucks. Silver pretty much unchanged. Crude oil up 40 cents, not much. Bitcoin up 400. I saw it up like 700 most of the weekend. And currency's kind of like pretty mixed. I guess, Chris, first thing first, because the tariff news was kind of headlines this weekend. And, it used to be 100 points, then it was 50 points. Now it's 25 points. Yeah. In another week, as this, the tariffs seem to me to be, these numbers are so arbitrary, like 25%, 30%, 35%, 40%, 100%, whatever it is. I mean, they just seem so nonsensical and so arbitrary. Like there's literally no rhyme or reason. There's nothing mathematical about it. There's nothing statistical about it. There's nothing historical about it. It's just arbitrary numbers designed to elicit some kind of a PR response. Is there anything else to it?
I don't think so. I mean, for all the hemming and hawing about this, the countries with which we've really established trade deals or countries that we have trade surpluses with, that doesn't solve anything. And so, yeah, I think the market still collectively, where's the volatility? That is ultimately the question we're asking ourselves.
Yeah.
The volatility is not back. We still have a sub 11 IVR with this news. I don't know, Tom. It feels like the half-life of these stories are getting shorter and shorter. But that my question then follow up to that is, does that mean we're in a place of complacency yet, though?
Oh, I think the market's at a place. Well, yes, I think the market is at a place well, it means two things. It means, first of all, that the whole impact of the Trump, of the Trump mandate, it's run its course. It's not, there's nothing left to it. It's not a trade policy anymore. It's a personal vendetta. I've been calling it idiotic from the start, and I'll keep that there, but it's really just a personal vendetta. Or a personal crusade. It's not a trade policy, and other countries they just laugh at us now. It's an absolute joke. So, I mean, we're still everybody's biggest trade partner, but we've become a little bit of an embarrassment. And I think that's reflected in the marketplace basically saying, the bond market just saying, hey, we don't care. The stock market saying, hey, we don't care. And the US dollar saying, well, we've shown you that we care. We've lost a lot of trust in US dollars. So, and I think that's where we're at right now. So I don't think there's much to focus on there. I just think, hey, the market does a very good job of pricing everything out. It takes a little bit, but it prices everything out and just says, okay, you know what? It's a non-factor now. And I really think it is a non-factor.
Tom, you mentioned earlier that this is a busy week coming up. There's a whole host of things to talk about, if it's economic data or earnings. There's also the expiration this week. Why don't we go there first, given everything that's happened recently? What's your take on the expiration, VIXpiration coming up on Wednesday? We obviously have the seasonal peak for the market, if you're a believer in that kind of stuff, on July 18th. So it feels like maybe those who are expecting a turn, maybe this is the week to think about it.
Well, early in the week, I think there's some risk early in the week, like Monday, Tuesday. After VIX expiration, things tend to get less chaotic, because I always feel like VIX expiration always opens itself up to like a little, far out of the money manipulation, that kind of thing. People mess with far out of the money SPX options. But going into Friday, from Thursday to Friday, which is the SPX expiration, it's been extremely bullish in 9 of the last 11 years. So I don't think there's a lot of end of the week market risk. I think if there is market risk, it's going to be early this week, Monday, Tuesday, Wednesday. And I mean, listen, we're starting off, I'm a little bit bearish and I went home a little bit short. So my preference would have been open flat and go down. I hate when they open lower and then, and then try to hold that down move. But again, I think the market is past the kind of the shenanigans in Washington. And I think the market is really focusing is looking ahead and focusing on other stuff. I just don't think that comes into play anymore.
Okay, so then when we look at the S&P right now with this open, it's not a huge move lower, but it does bring us back into the territory of basically where the July lows have been carved out. Does that interest you whatsoever? Would you think about operating in this area, 6240, maybe long deltas, or is this a time to add more short exposure?
No, I don't think it's a time for. I mean, I don't think you add long deltas when you're basically 40 or 50 handles off a high. I just don't think adding long deltas, when you're not even down 1% off your highs is not necessarily, you're not oversold here. If anything,
Fair enough.
I mean, we're just in a range. So It depends what kind of player you are. I mean, if you're like, damn, I missed it, I can't believe I missed it. I really wanted to buy this thing. And you feel like, hey, 1% is better than nothing. Then you sell some out of the money puts or some longer dated puts. if you're like me, you've got to be thinking that if you're really going to get a decent sell-off, you're talking, 5 to 10% would be, I don't even buy stuff unless there's a minimum in the S&Ps of a 5% sell-off, and I prefer something closer to 10. So I'm not even touching, the long side. I'm going to stay on the short side here. Plus, I'm not convinced with the bond market under 113. I'm not convinced that the next round of Fed action is going to be what people think it's going to be. So not with bonds right here. So I'm taking a very cautious stance, and until I see bonds start to rally, stocks are not that interesting to me.
While we're here in the bond world right now, this is a week without any Treasury auctions. So that's not something we have to look forward to. There's no Fed meeting coming up, but there is an inflation report. The inflation report's due out on Tuesday morning, 8:30 a.m. Eastern, 7:30 Central Time. Is that the most important thing you're thinking about for bonds this week, if you even care, or does the Fed not even matter either at this point?
I don't think the Fed matters at this point, and not at these levels. The Fed has two roles. When things are going their way, they can make an offensive decision, and when things are going against them, they have to sit on their hands and only can make a catastrophic, decision or save. I think at this point, it's based on where the bonds are trading. The inflation numbers are going to be horrible, meaning they're going to show, based on how the dollar's trading and based on how bonds are trading, the inflation numbers are going to show I would be shocked if they don't show a pretty steep uptick and they surprise people to the upside. Now, it's already reflected in the bond market. It's already reflected in the 10-year notes. So I don't know that there's going to be a big shock to the bond market, but I do think that you're going to see some pretty aggressive inflation numbers. With everything that's going on, tariffs don't knock down inflation. A lower dollar doesn't knock down inflation. You're going to see, you clearly see higher prices everywhere. And, that's a big part of, the current administration's platform was, hey, we're going to lower prices. And, clearly they don't have lower prices anywhere. So I think when that shock, kind of hits the market, it already has. The bonds are trading 112.28. It's already there.
Already there. Well, yeah, the market right now not expecting much of anything for the Fed here. So you say, I think that's an important anchoring point, right? Like if the inflation comes out warmer than expected, does it change the conversation around what the Fed's going to do? The market has right now, you say bonds being priced for it, 93.28% chance that the Fed keeps rates on hold. So it's not like people are on the side of we need some action here. Tom, for me, notes directionally neutral has been working really, really well the past few weeks and months. But it's only a 5 IVR right now. Given the fact that volatility is really low across the board, you go to equities first and it's down there, so you look elsewhere. Do you operate in notes with a 5 IVR, or do you perhaps keep scanning your watch list for other opportunities before you check in with a trade?
If you want to trade notes, clearly, I think this 110 level or 110.5 where they are right now is actually a really interesting entry point. I've been selling puts in there because I like this 110 level. I don't want to see notes get back to the 108, 109 level. Then they're going to get really testy. But at 110 right here, I think it's a good entry spot if you're inclined to, want to take a small shot on the upside on notes or bonds. The notes are about half the risk of bonds. So for people that have never traded, notes or bonds before, it's a good, it's a very good entry. It's a good entry product. Listen, I'm trading both of those, and I'm just a little nervous. I don't usually get nervous trading bonds. I'm just a little nervous because I don't like the tape action there. No matter what, they just are so freaking heavy. No matter what. Yeah.
They feel heavy. And I think that's a great point you bring up, by the way, about the difference between notes and bonds. Tick value in notes, for those that don't trade these or are familiar with them, $15.62.5. For the bonds, $31.25. Overnight buying power is effectively half notes for bonds. So if you're dipping your toe in there, I always, TLT serves a role as well to fine tune it, and you can go to the different treasury products.
Yeah, but you can't trade it like you can't trade it tonight, like that kind of thing.
No.
There's 100 times more notional volume in the ZN, so that's I like that.
Before we go into the earnings calendar, which I think is a really important part of this week, we're in rates, so let's just skirt through currencies and the metals real quick. The dollar has finally started to bounce a little bit. It hasn't made a turn yet. I'm playing for a dollar turn. I've been loading up on yen puts in 6J. This has to be appealing for a contrarian like yourself, where every metric we look at shows the dollar being significantly oversold or among the most shorted trades in the world right now.
I would agree with you, except for the yen. So I am actually long yen.
Oh,
I am long dollar. I know you're thinking that I'm just playing devil's advocate, but I'm not.
You're not so I'm not worried about that.
I have been long the yen for the last year, and I am not getting short the yen until the cows walk home. So I am staying long yen into perpetuity, and I do it by selling out of the money puts, usually 1 or 2 pennies below where it's trading. Like right now, I'm short the 68.5 puts and the 66.5 puts because it was up in around 70. But I like being short puts in the yen. They trade rich relative, and they and I'm bullish in the yen because it hasn't gone anywhere in a couple of years. And I think if any one of the currencies has the potential, to have a nice little bounce back, it's the yen. Other than that, I am short the euro here, and I'm short the Canadian dollar. And I think that the other currencies have just gone too far in too short a period of time against the U.S. dollar, even though the U.S. dollar scares me because I don't think we've seen a move of this magnitude in the U.S. dollar, which is a clear reflection on global confidence in the U.S. The U.S. has lost its buying power. It's lost its confidence. It's lost its edge as, we're still the global superpower, but we are no longer the respected superpower that people will go to store dollars. That's why bonds are lower, and that's why Bitcoin's higher. That's why bonds are lower. That's another reason why bonds are lower. And it's why the actual purchasing power I think 30% or so, I'm not sure the exact number, but I read that 30% of the Treasury debt is non-US. And I think 30% of I think it's a little over 30% of people that own equities are non-US. So for all those people that bought, using any other currency other than dollars, they're not up any money. So if you bought stocks, you're not up any money. You're down almost 11 or 12% this year. If you bought bonds, you're down, 20%, because you've lost on the currency conversion and on price, on principal. So foreign investors that make up, let's call it, okay, I don't know the exact number, but I think it's around 12 to 15 trillion dollars of bonds and 12 to 15 trillion dollars of equities in US markets. Those investors haven't made a dime, or they're down a lot of money, and they're choking on US investments because the dollar, even with the market at all-time highs. If the market was to turn around, that will accelerate some of the international sales, and the bond market's already been attracting sellers. So that's the scary thing right here, is when that's a direct result of our of a very poorly designed and poorly executed trade policy.
Tom, I got to give you credit. Not that I doubt you, but you got those numbers spot on. About 30% of the bond market is owned by foreigners. 12 to 18% is equities. You have the numbers right in the trillions. And so it begs the question, what does this mean? This is the worst start ever for the US dollar since Nixon took us off direct gold convertibility in August 1971. That's got to mean something.
Right? On a short-term basis, you have to, as a trader, on a short-term basis, you have to look at it as a cyclical move. So sure. As a trader, I don't think of it in a very, I don't have this long-term view, and I think of the dollar on a short-term basis as being, as this being a very cyclical move, making up for, 10 years of rallying or whatever. And I'm trying not to think of it as a complete loss of faith. I know that much of it is a loss of faith. That's how we can tie it back, but I'm trying not to think of it that way. I'm trying to think of it as a cyclical move. And as a trader, I'm trying to think about, okay, how do we trade this? If it continues into, late 2025 and early 2026 and beyond, then Houston, you have a problem, because then, you're getting into like Japanese territory, and then you're running the risk of, and this has been my whole issue with an isolationist policy from the start, is in a world that is moving towards globalization, we cannot be moving towards isolation. And it makes no sense to me. And if that's the case, the dollar will not come back.
You mentioned the dollar losing value, and you specifically name check crypto, Bitcoin, about why this is going up. The dollar defiance, if you will, people losing faith in it. Bitcoin had a really good end to the week last week. Now a new high, and it's still here, up by 0.32%.
Yeah.
What's the play here for you? How are you handling crypto at this juncture?
Well, the problem is, I'm handling it the same way everybody else is. We're just sitting here long some crypto,
Okay, good. Good.
Yeah. I mean, because you can't really sell it and you don't really trade it. You just kind of buy it and hold it. The problem with crypto is it's a very small asset class on a relative basis, and it's not for everybody. But clearly, if you there's a lot of people that feel more comfortable being long Bitcoin or ETH than they do being long US dollars. And so I think that's part of it, but there's also a lot of I think there's a lot of froth in the Bitcoin marketplace right now, a lot of froth. And I don't particularly like, all the additional leverage and all the froth in there. So I'm not buying it here. I'm not adding to it. I think it's rich.
Could I pitch the other side of this? As
sure.
Someone who's in IBIT right now, it's also in the Tasty Follow account. A few weeks ago, we went long the 75-85 call spread, because this, from a technician's perspective, this looks like it's fairly bullish. The past week, over 8,000 Bitcoins were loaded up by institutions, whereas miners only were able to produce around 1,000 during the same time span. There's this imbalance right now as all this liquidity is coming into the market. There's a clamoring for Bitcoin. So, I know you're saying you're not fading it, right? But for me, I think this thing could rip another 20K in like a flash. And I don't see it being cooked. Like, where are the videos of the guys in Miami on their yachts? I keep bringing this up, but I'm not seeing them anymore.
No, the scary thing about this Bitcoin move, and I've been very vocal about this, is I do not like it's, to me, this is it's the Bitcoin, the commitment to capital for equity firms that are just buying digital assets as a strategy is unhinged to me. It's unhinged because they are floating, right? That a market is out of control and is so complacent and so lacking the necessary know-how and discipline. If you are willing to loan somebody money without receiving any interest for your loan, and without a definitive conversion rate, it makes no sense to me. I wouldn't give a single person in the world a dime unless they told me what they were paying back and what was either collateralizing it or what was the conversion rate. Nobody would. And all of a sudden, in the world of digital assets, you're willing to give to some complete, reckless CEO, just who says, "Oh, I love Bitcoin. It's going significantly higher." Okay. I mean, that's crazy talk. So yes, I'm not selling my Bitcoin, but at the same time, I mean, I just don't, I think it's insane. I think the whole movement, well, a lot of that buying that you talked about is all from, these firms just raising capital, billions of dollars, just in convertible debt, which isn't really even convertible debt. It's more like smoke and mirrors. So I don't like that. And I think that house of cards is going to come crashing down at some point.
I understand that. I just hope it's after these options go into the money.
Well, it's so interesting because there's also, a lot of these, Bitcoin ETFs are still paying, 40 and 50%, annualized dividends because they continue to rally. And then there's these huge payouts. So they're really suckering in people, people are like, well, how can I buy Bitcoin and make 50%, on a annualized return? Well, if you're making 50%, trust me, you're taking risks somewhere.
Tom, we want to keep scooting through here because we want to hit the metals, energy, and then go over to the earnings calendar before we close this out. Silver had a huge day on Friday, up nearly 4 or 5%. Gold here is firmer at the open as well, up by nearly 0.5%.
Yep.
Volatility is not too high here in the metals, at least on an IVR basis. But what's your overall take this week?
It's come down a lot in the last week. Yeah, the gold silver ratio completely crashed out. Silver's been an absolute stud. And the premium in gold, like you just mentioned, has come in significantly. We were up in gold in the 70s and 80s in IVR, and now we're down into the low 20s. So you've got, it might even be below that. So you've got to be really careful here about selling premium in gold. I don't love the risk reward anymore. I think silver's actually better, but silver's not the most liquid contract. So just be careful if you're jumping into silver. And, but yeah, that's where I see that market.
Jamal had a really good point last week. He was getting out of his silver futures contracts and moving over to SLV just to be able to manage the position a little bit better, given some of the liquidity issues that he was seeing around the strikes he wanted to operate in. Not a lot of open interest, and that's one of the considerations, of course, you have to make. Never Hotel California yourself into a position. Crude oil here. Oil had a little bit of a move higher last week, but IVRs are in the 30s. Does that interest you? It's better than stocks? No?
Yeah, it's better than stocks. And it's been hanging around. It's been a nice trade, actually. I think it got down to the point where crude oil forced us to cover all our short premium, and it was a really good trade. But I think you have to be patient in there and wait for a vol expansion. You will get one. And it will come, and it'll probably come in the next couple of weeks or whatever it is. And as soon as you get a vol expansion in there, whether it's in the crude oil in the 70s or crude oil in the 50s, who cares? Whenever you get a vol expansion in there, you can, lay out some premium. But for now, we're going to stay flat. It's the least interesting, I'd rather be in, for example, natural gas than crude oil right now. It's just more interesting to me. There's more juice.
Natural gas certainly has the juice, 46.9. I abandoned ship here in a long delta position last week. I was short some put spreads. Wasn't working out. We broke the bottom side of the range. No longer a trade for me per se, but I'm still eyeing it because that's a healthy 46.9 IVR, which we don't see elsewhere. Okay, Tom, we have 5 minutes left here. We've talked about the economic calendar. Inflation's really the game in town this week. We've looked at all the asset classes, but we do have a big earnings calendar this week alongside Vixpiration. Monday before the bell, you have fast and all, but I don't think anyone's really getting out of bed for that. Things pick up on Tuesday with the banks. Banks have been doing really well this year. XLF just a few points off of its highs. JP Morgan, Wells Fargo, BlackRock, Citigroup, the Bank of New York Mellon on Tuesday. Let's go through this day by day. Which of those are you trading?
Currently, no position in any of them because the IVR is pretty low, but it's getting up to the level where it's tradable now for earnings. But here's my problem with banks. This is one of the weirdest regulatory environments that we've seen since 2008. So in 2008, banks, financial institutions, banks, everything, it was banks gone wild. And they basically had complete disregard for, all regulatory boundaries, all common sense, everything. And we've seen that a couple times throughout, last, 2 decades. But then everything tightened up and banks cleaned up their act and the stocks cleaned up their act. They picked up some cash. They've done really well. In the last 6 months, there has essentially been the regulatory agencies that monitor banks and financial institutions have been gutted. And they have essentially run wild with virtually no regulations. They've been, they're going to say, oh yeah, we all passed the stress test and this and that, but it's like self-administered. It's the most lenient regulatory environment that we've seen in almost 2 decades. That usually leads to some good numbers right out of the chute. That usually leads to, because areas of business that were heavily regulated, when you drop those regulations, they tend to be able to work the numbers a little better and also build up business a little better. So sure. And they also
flurry of activity, barriers come down. Everyone wants to get out of the gate first.
They don't have to pay their fines. They get rid of they get to reinstate the fees, all this kind of stuff. So
we did that, by the way. Overdraft fees are now back, thanks to the recent bill.
It's sad, I know. And there's like
who voted for overdraft fees?
Oh yeah, because you vote for the
bank.
Show yourself. They all did, but there was crazy things like Navy Federal, the credit union. They had a $90 million verdict, and to pay back. People that had investments that were charged, basically criminally charged fees, and they just eliminated the entire debt. So they were like, oh no, you don't have to pay it. Don't worry about it. That kind of thing. So the numbers are going to be really good for banks. But the question is, A, is it sustainable? And B, it's probably somewhat already priced in. I'm going to take a very cautious approach here. I do not like earnings when volatility is really low. If you get a pop and vol here, earnings will be interesting. Without a pop and vol, I am not a big fan of earnings here. And especially these banks, they scare me because without regulatory boundaries, who knows what numbers they're going to put up.
Okay, well then, can I throw you something that's a non-bank in your direction as we wind down the show? TSM and Netflix should be out Thursday this week. You have GE Aerospace and Abbott Labs as well. Netflix is a 37.7 IVR. That's certainly more appealing than any of the banks.
Yeah. Well, okay. So Netflix is untradeable. So if you've tried to trade Netflix, it's basically untradeable. I know you're going to look at it and it's going to get like, oh, this is interesting for earnings. I mean, Netflix was a very tradable stock at $200, $300, $400. But when you're talking about Netflix, $1,200, $1,300, it's not a stock. The markets are super wide. It's really, where's Netflix now, 1250 or something? Yeah,
right around there.
The markets are super wide. They trade by appointment only. Okay. And I'm always worried at $1,200 about a Netflix like 10-for-1 split, because it would make sense to me that they would split 10-for-1. So I have this outlier fear. Plus Netflix has been a little bit heavy, I guess, recently, but I just think you're going to find it as a retail investor with a $1,200 stock. You're going to find Netflix incredibly difficult to trade, and it'll be defined risk only. I don't think it'll be a big earnings trade. TSM, on the other hand, very different, much more tradable. It's like it's a poor man's Nvidia.
Okay.
It's tradable. The markets they're 3 stars instead of 4 stars. So you can definitely trade it. You can do something naked in there if you want. It does have a history of some outlier moves, but I think in the case of, TSM's had a huge rally. It's kind of like, it's basically been tick for tick or so with, look at that rally. What do you want to do here? It hasn't had a downtick.
Almost, right?
Yeah. It's definitely tradable. It's a poor man's Nvidia. So you want to play you want to play a few, I don't know, you want to give it a shot? Sure. I trade TSM, so I'm sure we will do something in TSM. I think the upside, given how much the stock's rallied, I think the upside's probably a little bit limited. But I don't know what I'm going to do in there yet.
Well, it's an $11.10 implied move through the end of the week. Looking at an iron condor, that's $5 wide, wrapped around the one standard deviation move, 63% probability of profit, risking about 3 to make 2. Those are pretty decent odds right now, Tom. You mentioned the markets being a little bit better. One of the things that we like to do as traders, do these quick liquidity checks. What's the volume? What's the open interest look like? One of the reasons why, right, is what you just mentioned here for the audience. How do you know that? Well, you see the open interest, thousands of contracts, even the volume here, thousands of contracts traded. You go to NVIDIA, you're not seeing that same type of thing. What are we talking about right now? Maybe. Depends where you look. But you really have to be able to get it in and out of the market. You don't want to get trapped in a trade. I know some copper folks were kind of trapped in a trade last week when, even if they were long.
Copper was bad, but TSM you can trade. You can do defined or undefined risk. But if you've never traded it before, just stay small in there, and I think I'm going to lay out some upside premium, but not crazy. Just because these stocks have had a huge move. I'm not bearish in there. I'm not like really bearish in there, but I mean, anytime I see a move like this, like I still want to sell puts, but
sure,
reluctantly. Yeah, I think that Netflix untradeable, TSM tradable. The again, it's all going to depend what happens in vol this week. If vol crashes out this week, I'm going to trade these super small. If vol expands at all this week, we'll have an opportunity to do something a little bit bigger. I mean, S&P's down. We've been going for half hour since the opening. S&P's down 25. This is right where they opened, 73, 74. They got about 8 points lower and maybe 2 or 3 points higher. NASDAQ down 104. It was maybe 20 handles lower. Russell was 5 handles lower. It's down 12. Bonds down 1. They moved in 1 or 2 cents all night. Notes have been up small all night. And, crude oil is basically unchanged. Gold's up $18, was there all day, and Bitcoin hasn't really moved. It's up $500. I mean, that's kind of the whole Sunday night story. I think it's actually going to be I think it could be a decent trading week, Chris.
I hope so. I hope we get some volume back here, Tom. Hey, you know what? The hater said that it couldn't just be me and you for the entire show, and we did it. But you have the final word.
Oh, I actually love doing the show with less people, sometimes just because you get to talk about more topics. So yeah, Victor had a technical difficulties tonight, and but thank you for sitting in for Mr. Spivak and Mr. Jones. And just as a quick reminder, the show's going live in Boston right now, but there is Dr. Jim did do a piece, and it's coming on immediately following Chris and I. And so it's a crash course. It's wonderful. It's geared towards demographics, like Chris said, in the 40 to 60 range. But I think you're really going to like the piece that Dr. Jim put together. And don't forget, we kick off tomorrow morning with Rich and Angie at 1:30 in the morning. Central Time, and then we pick it up with Forex show at 6:30 Central Time, and then Tony and myself at 7 a.m. Central with Vanetta. All right, last words here, Chris. Looking forward to this week. It's pretty hard, given the fact that we just maybe sold off 50 handles from our highs a couple days ago, and the market just completely blowing off all the tariff stuff. It's pretty hard to be super bearish here. I think you take a cautious approach, and if you want to play the downside, which I'm playing right now, I think the downside looks good. Maybe up until the VIX expiration on Wednesday, which is pre-market, and then after that, I'm going to probably take in some of my shorts and see how the week finishes out. But I'm not going to stay short from Thursday into Friday.
Tom, I know it was Tony's birthday in the last few days, but for the sake of my birthday coming up, let's rally the market into this Friday. Okay? That's the final word.
I would prefer they rally the bonds, quite honestly. I have way more bonds than I'm long bonds here. It's my biggest position, and I'm short stocks. So
I'll buy some bonds for you. I'll buy some bonds.
Please do. I need the bonds to go higher.
I'll be your exit liquidity.
Thanks, everybody. Thanks for tuning in tonight. Have a great week. And Chris and I will see everybody tomorrow at different times on the network. Thanks so much.
This is Jimmy. He's 55 years old, married with 3 kids and 3 grandkids, and he's been investing ever since he graduated from Central Michigan University, fire up chips, over 30 years ago. And given how strong the market has been these past 3 decades, he's done really well for himself. In fact, his retirement portfolio just crossed over the $1 million mark. But he's stuck, earning the same old 7 to 10% annual gains from the market each year, and he's at the mercy of market volatility. With hopefully only 5 more years to work before he retires, Jimmy wants more control. He wants to take hold of his future and his returns. Well, my name is Jim Schultz. I'm a finance PhD, and I've devoted my entire professional career to understanding the markets, starting as a professor in academia, where I taught undergraduate and MBA classes, and also did my academic research solely focused on the markets. I've since been a practitioner in the markets, actively trading since 2007. For the purposes of this video, I'm going to be Jimmy. So I've had a great run in the market over these few decades, but now I want to really unlock the full potential of my portfolio. While the 10% average annual return that the market has given me has been great, I'm intrigued at the prospect of producing portfolio returns that are even higher than that. I've heard with enough skill and ability, it might be doable. And maybe even more importantly than boosting my returns, I'm very interested in reducing my overall portfolio risk. Being that I'm closer to the end of my career than the beginning, I want to be better prepared to handle extremely volatile conditions or big market meltdowns, like we had during the internet bubble in 2002, the financial crisis in 2008, the COVID crash in 2020, or even the trade wars and tariffs that we're experiencing right now in 2025. Well, whatever the reason might be for you or Jimmy, if anything about his story resonates with you, then you are in the right place. I'm going to show you how to begin to make the transition from a purely passive approach with your portfolio to a much more active approach that steps into the world of derivatives. And we're going to break it down into 5 simple steps as I take Jimmy through a first-hand example. And we start with step 1. Taking inventory of where you're at. I've taken the passive approach and it's worked out great, but it's important to remember that those 10% average annual returns are exactly that, an average. While the market does go up most of the time, it can also go down and sometimes seemingly out of nowhere, just like we've seen to start 2025. Well, that is what I'm trying to avoid. Until now, I have been simply buying and holding, absorbing whatever blows might come my way. But I am tired of this lack of control. I want to be more involved. I don't want to be so reliant on market direction for not only generating returns, but mitigating risk. Now, you may be just like Jimmy. You don't want to stand passively by, needing the market to move higher to hit your return projections. All the while, the performance of your nest egg seems to be directly tied to the next Trump tweet. You want to take control and add a brand new strategic component to your portfolio. Well, once you fully immerse yourself into the world of derivatives, all those things can happen. But before we dig into the real details, we have to progress to the next step in the journey, where we are now going to tap into all the tools that were available to you as a passive investor who was reliant on the market moving higher. Specifically, let's talk about the power of dividends and dollar cost averaging. Step 2, the tools you need. Now I'm ready for action. I'm going to ditch the purely passive approach, but to be fair, I have done really well as a passive investor over the last 30 years using the 3 Ds, direction, dividends, and dollar cost averaging. So naturally, there is still a part of me that really likes all these strategies. The thought of abandoning those long bias strategies completely has me feeling a little bit uneasy. Well, here's the great news. Continuing to collect your dividend payments or improve your basis through dollar cost averaging are both still very much in play. You're going to see that there will still be a home for you to carry some share positions in your favorite stocks. And even in the options portion of your portfolio where you might not own any direct shares, any dividends that the company might pay automatically get factored into the option pricing. For example, if instead of buying stock in Apple, you decide to use a short put position, which is a classic option strategy, you are still going to collect any upcoming dividends that Apple might pay with that short put strategy. This happens because you're able to sell the put for a higher price based on the simple fact that the extrinsic value moves higher due to the dividend itself. But all of that is way beyond where we want to go here today. Not to mention, we've already done a video that covers all of that in depth, and you can watch it right here. But what about dollar cost averaging? Well, I learned early on that it was a great long-term strategy to add to my investments in individual stocks or broad-based indexes when the price of those stocks or indexes was falling. If the company was solid or the overall economy would be strong again, then I knew there was a really high probability that the stock prices would recover. Well, with derivatives, high probability trades are at the core of what we do, and here is the best part. It happens right at trade entry. You don't need to wait for the stock to drop or things to go south. You start improving your basis right from the very start. Now, I'm very happy to hear that both the returns from dividends and the spirit of dollar cost averaging can be alive and well with the option strategies inside my portfolio. But now, I'm even more intrigued to hear about how I can actually make money without needing the market to go higher and without being so reliant on market direction. That sounds crazy to me. Well, both you and Jimmy are in luck because that is exactly where we're headed next. Step 3, trading time and volatility. Now, I have to be honest, this completely blows my mind. I was under the impression that to make money investing in the stock market, you buy stocks and you need a move higher in the stock to make money. Well, it turns out that's not necessarily true. It's important to understand that in the world of options, any position you might have can and will make money from 3 different parts: direction, time, and volatility. So let's start with direction. Now, working through all the inner workings of calls and puts and option pricing is way beyond our focus here, and we can't get into it in this very video. So I would encourage you to watch this video right here. For the sake of Jimmy's goal, we want a broad overview, and it works like this. There are option strategies where if I'm bullish, I benefit from the stock price going up, and I'm hurt by the stock price going down. So very similar to being long stock. There are also option strategies where if I'm bearish, I benefit from the stock price going down and I'm hurt by the stock price going up. So very similar to being short stock. But here is where things get interesting. With options, if I'm bullish, I can set up a strategy that benefits from the stock going up, but can also make money if the stock goes nowhere, and even possibly make money if the stock goes down a little. And similarly, if I'm bearish, I can set up a strategy that benefits from the stock going down, but can also make money if the stock goes nowhere, and even possibly make money even if the stock goes up a little. And the reason we can do that is because with options, we're not only trading direction, we're also trading time and volatility. You see, with options, there are various components to an option's price. The underlying stock price of the stock the option is on is a component. The risk-free interest rate in the economy is a component. Even the dividend that the company might pay is a component, just like we saw in the last section. But one of the largest components to an option's price is the time that is left on the option contract. Every option contract expires on a specific date. So some contracts might expire in 7 days, some might expire in 45 days, and some might expire in 360 days. Simply put, the more time the option contract has, the higher its price. As time passes, the number of days left in the contract decreases, and so that time value follows suit and also decreases. Here's the best part. You can play any directional bias you want, but you can also play time along with that same strategy. More specifically, you can benefit from the simple passage of time. As the days go by and the time value dissipates from that option's price, it helps the P&L on your position. Now, for our strategy examples coming up, we're going to focus exclusively on time, but it's important that you're made aware that you can also trade another non-directional metric, volatility. Now, volatility does share a reliable relationship with direction, but we'll leave that discussion for a future time. For us, we want to understand that much like time value is added to an option's price, a volatility premium is also added to an option's price. And also very similar to time, More volatility means higher option prices, and lower volatility means lower option prices. This will come as no surprise, but this video right here explains volatility in great depth. But for our purposes, here is what we need. Market volatility moves up, it moves down, it moves all over, just like everything else in the market. But generally speaking, on average, volatility is in a state of contraction, so it's moving lower. And just like we did with time, we can set up option strategies to take advantage of that natural volatility contraction. But now you've got to be wondering, all right, I see how time can help me, but I still can't for the life of me understand how I can make money without being directionally right or even being directionally wrong. Well, that's where we're going next. Step 4, strategic breakdown. So let's unpack 3 different strategies, starting with a covered call. I'm used to owning stock, and one of my favorites over the years has certainly been Apple. Well, the beautiful thing about a covered call is that it starts the same way that all of my positions have started, with long stock. The difference is, on top of that stock, we're going to add an option component, specifically a short call. This is what is called a covered call strategy. Let's suppose I own some Apple that I bought earlier this year for $180 per share. Today is April 9th, and right now in the option market, I can sell the 200 strike call in the May cycle that is 37 days away for $2.50, which is $2.50 per share, or $250 for the whole contract, because option contracts are always in 100 share allotments. Now, a key part to understanding how a covered call works, or really any short premium strategy, is this. If the stock price is above the strike price on a call, the call is in the money, meaning it has value. But if it's below the strike price on a call, the call is out of the money, meaning it is worthless. If the stock price is below the strike price on a put, the put is in the money, meaning it has value. But if it's above the strike price on a put, the put is out of the money, meaning it's worthless. And when you sell options, you always want the options to be out of the money. That is because that allows you to keep what you sold it for. So back to my covered call. Let's explore 4 simple scenarios by May expiration. Apple goes to 160, Apple goes to 200, Apple goes to 220, and Apple stays right at 180. If Apple falls to 160, then I'll lose $20 per share on my stock, but my short call will expire out of the money, so it will be worthless, which means I'll get to keep the $2.50 I sold it for. So my net P&L is improved to only losing $17.50, which is good. If Apple rises to 200, then I make $20 per share on my stock, and my short call expires exactly at the money, which is the same as out of the money at expiration, which also makes it worthless. Again, this means I'll get to keep the $2.50 that I sold it for, so my net P&L is improved again up to $22.50. Also good. If Apple rises all the way to 220, I make $40 per share on my stock, but now my short call slows me down because it is in the money. I do get to keep the $2.50 I sold it for, but now the short call loses the difference between the 200 strike price and the 220 stock price. So again, my net P&L is plus $22.50, which is good, but not as good as it would have been if I just held the long stock only. But lastly, what happens if Apple stays at 180? It moves around, up and down, sideways, whatever, but at May expiration, it's right back to 180. Well, I don't make or lose anything on the stock, but again, my short call expires worthless, so I get to keep the $2.50 per share. So in other words, I generated a positive P&L on my position without needing the stock to go anywhere. And that, my friends, is the power of options. Not to mention, I also improved my net P&L in 2 of the 3 other scenarios too. Okay, so next up, the vertical spread. And specifically here, we're going to talk about a short vertical spread using put options. So this would be a short put spread. Let's use Tesla as our example. Here, I won't have the familiarity of long stock to lean on, as my position will be solely options. but I'm bullish on Tesla, so I want to set up a short put strategy in the May cycle with 37 days to expiration. To do that with Tesla at $250 per share, let's say I set up a 225 220 short put spread that I'm able to sell for $2 in the May cycle. Now, an important aspect of short vertical spreads like the one I have here is that my maximum gain is always whatever I sold the vertical for, so $2, and my maximum loss is always the difference between the width of the vertical and what I sold it for. So $5 width minus $2 credit, or a $3 max loss. So let's work through 4 different stock price scenarios. Tesla rises to 300, Tesla stays at 250, Tesla goes down to 230, and Tesla goes down to 200. First, Tesla rises to 300. In this scenario, this short put spread expires out of the money, so it's worthless, which means I keep what I sold it for, and my P&L is plus $2. Next, Tesla stays at 250. In this scenario, again, the short put spread expires out of the money, so it's worthless again. I keep the premium, and my P&L is plus $2. Next, Tesla falls to 230, so it went down when I wanted it to go up. But here's the crazy thing. Again, the short put spread is still out of the money, so it's worthless. I keep the premium, and my P&L is plus $2, even though I was wrong about the direction of the stock. And lastly, Tesla falls to 200. In this scenario, the short put spread is fully in the money, so this trade would be a loser, where I would lose the most I can possibly lose for a P&L of minus $3. Now, as you can see, I'm not hitting home runs when the stock moves in my favor in this Tesla example. Not at all. But it's pretty crazy that I'm able to make money when I'm wrong on the stock price direction completely. Well, that is exactly what we meant earlier when we said you're able to benefit from the passage of time. When you sell out of the money options, if they stay out of the money, then you are able to allow that time value to drive your ultimate P&L. So now, the third and final strategy, the short strangle. Here, let's say I want to do an option strategy in Starbucks. And for this one, I don't think Starbucks is going to move much between now and May expiration in 37 days. So I want to set up a strategy that is a pure time play. It could be a volatility play too, as we alluded to earlier, but for these examples, again, we're just focused on time. So with Starbucks at $95 per share, let's say I sell an 80-110 strangle. So an 80 put and a 110 call in the May cycle with 37 days to go for a $4 credit. As long as Starbucks stays between 80 and 100 at May expiration, both options will expire worthless, and I'll keep my $4. So that means it could go up to 105, it could go down to 82, and it could do everything in between. It won't matter to me, and it won't matter to the position. As the time value comes out of the option by expiration, I will make the $4 profit from time alone. But here's the catch. Anything above 110 or anything below 80, that's where my risk is. And even more specifically, I have an unlimited amount of risk on both sides. Now that right there, you might be thinking, man, I am out. I am not interested. No thanks. Well, that makes sense, because you're just getting started. I just wanted to take the opportunity right here, right now, to introduce you to the short strangle, because it continues to be one of the most popular and effective strategies that experienced traders use every single day. And you yourself are probably striving to become an experienced trader one day. For now, though, there's no rush. This is not a competition. Start with covered calls and then move into vertical spreads. There will be plenty of time for other strategies like short strangles sometime down the road. I promise you, covered calls and vertical spreads alone are going to keep you plenty busy. All right, so next up is the final step of this whole crash course, where we are going to work out some different ways that you can break down your total portfolio and show both you and Jimmy how you can split up your assets between a passive approach and an active approach. Step 5, portfolio allocation. So now I'm beginning to equip myself with more skills to attack the market from a variety of angles. I can trade time, and I can trade volatility in addition to direction. But to do that, we have to figure out how are we going to split up our assets. More specifically, what chunk, what percentage of our assets are we going to keep doing what we've always done, and what percentage of our assets are we going to devote to this brand new derivative strategy? This is a really important question to answer, and here's the most important thing to keep in mind. You don't have to go all in with 100% of your assets into an active approach in the derivatives market. Definitely not when you're just getting started. It's understandable that shifting away from a passive, long only bias in the market that has done you so well for so many years is going to take some time. But practically speaking, what might some asset breakdowns look like? Well, if you remember, my retirement portfolio just crossed the $1 million mark. And in addition to that, I also have a $100,000 brokerage account that I might use to play a hunch from time to time. So in my situation, the starting point here is easy. While I'm certainly intrigued at the prospect of not having to be passively long all the time, I'm still confident that the upward trajectory of the market will continue to some degree or another. So I'm going to start with my $1 million retirement portfolio, still doing what I've always been doing, long some market indexes and some of my favorite stocks, but I'm now going to devote my $100,000 brokerage account to a more actively managed approach that focuses on derivatives, just as we've been talking about today. So that means that $100,000 of the $1.1 million total, or about 9% of my assets, will be actively traded, and 91% of my assets will continue to be passively invested. This is a great start. And over time, as I gain more experience and my skills improve, I suspect that that ratio is going to shift in favor of more assets being actively traded. But maybe you have a $500,000 retirement portfolio and a $200,000 brokerage account, and you want to devote more assets to the active approach now. Again, I think splitting up the approach to whatever is in your retirement accounts to passive and whatever is in your brokerage accounts to active makes a lot of sense. So here you would be about 29% active and 71% passive, so still the bulk of your assets passively invested, but a much bigger chunk devoted to the active approach. Or maybe you have a $200,000 retirement portfolio and a $40,000 brokerage account. Again, with the natural split of retirement assets into passive investments and brokerage accounts into active trading, you're looking at about 17% active and 83% passive. Of course, you don't have to do it this way. You don't have to use your retirement accounts for passive funds and your brokerage accounts for active funds. You can certainly do it a different way. You could even mix it up if you want to. But when you start to learn about things that we were not able to cover in this course, with buying powers and margins and things of that nature, it does make sense to begin with passive funds in the retirement accounts and active funds in the brokerage accounts. There are many, many, many ways to split this up. But whatever you decide, here are some important things to remember. First, by keeping some amount of your assets in passively invested positions, you'll maintain the familiarity of what you've been doing your entire investing career. So playing the natural market drift higher, collecting dividends, dollar cost averaging, all that stuff. Second, remember, the strategy I suggest you start with for even your active stuff is the covered call, which we introduced just a little bit ago in this very crash course. So even within the active portion of your portfolio, you'll have that same familiarity of long stock. From there, you can grow into vertical spreads, possibly even short strangles down the road, and many, many other strategies. But lastly, again, do not forget, this is not a race. This is not a competition. The market will always be here. So don't go fast just for the sake of going fast. And don't dive into the deep end before you've even dipped a toe into the water. You're going to mess up and you're going to make mistakes. So ease into the active approach little by little and only do it as you are ready. And I'm here to help you as much as I possibly can. So please, you can always email me. I'm jschultz@tastylive.com, or we can connect on X @jschultzf3. But now, where do you go from here? Well, given the nature of this crash course, there were so many things that we were not able to unpack, that we were not able to dive deeper into. And so, if you want to use this crash course as a catalyst to improve your skills and improve your abilities, then I would strongly encourage you now to dig into the live show on the Tasty Live Network, dig into the archives, and maybe possibly even check out some of the other crash courses that are already available on the network and on the YouTube channel, such as the one that dives deeper into what it means to begin to trade options, and it happens to be starting right now.
Good morning, happy Friday. Welcome to Trade Live with IG, myself and Scotty Byrne.
What a day to be alive, eh? Beautiful weather.
Isn't
Sitting
it?
here in the IG studio, sitting with you. What a day to be alive.
Well, almost we weren't though, because I forgot my pass to get into the building this morning. And I walk in and Scotty's standing because producer Phil hasn't put his name on the security gate.
Just
so
confirms I'm a total nobody.
we could have done the show from downstairs though.
Oh, that could be an idea.
Yeah.
Set up downstairs for a one-off.
Yeah.
Imagine the boys in the gallery are trying to get all that done.
Oh, the roaming camera.
Yeah, in Greg's. You could walk into Greg's.
Not the woman's.
Yeah, not the roaming gallery. Yeah, the roaming one.
Strike him, Centurion. Right, Bitcoin up and away. That's right, two-tier keyer getting very excited from the off. We will cover that and more. But what is coming up on today's show? Friday, the 11th of July. We're mixing up a bit today, actually. we got myself and Scotty only till 8:15, and then we've swapped that over. Scotty Byrne coming in with Esar for the week ahead. We've got him in all the way from the far reaches of Essex. We don't want to just have him for half an hour.
That's right. Don't want to squander your best resource, do you?
And then myself, Angeline, we talked to Bill Blaine with an E on the end of his name. What is going on this morning? They think they're already in the weekend.
Friday Gremlins. Friday Gremlins, that's all it is.
System error.
Yeah, exactly.
Right, and then we... you're going to do the old sessions, are you, Scotty?
Evidently.
Evidently.
Yeah, looking forward to that.
God, that's you on extra time.
I know, absolutely.
Overtime.
I know, I'll start slapping tariffs on if you keep taking all my time like this.
Number of the week, Angeline and Chris Beecham at 9:15, and then Jack Maguire to finish you off for the week. But let's have a look at where we're sitting at the moment on these future markets. 62.62. We're down 27 basis points despite Trump coming out with a threat of 35% tariffs on Canada. And Europe's next.
Well, this is it. I mean, as we were talking before we came on, I think he tweeted, I think I saw it on the CNBC website, he's tweeted, I mean, he's in full tweet mode as well, but
yes.
Basically, the market's loving my tariffs. It made a new high yesterday.
Tariff,
I did see,
tariffs.
interestingly, that he's put slapped the tariffs on Brazil.
Yeah.
Tariff,
50%.
love the tariffs.
And they've actually got a trade surplus with the US.
Well, and this is the strange thing. It's now being used as a political weapon for the first time.
He's going after everyone. The Brazilians, Powell as well. You can't redecorate the Federal Reserve. Misappropriation of that was another. Have you not?
No, I haven't seen this.
Accuses Powell of mismanagement of the Fed. I don't know if he got like some new carpet in his office or some new post-it notes.
Or like Boris' wife.
Yeah,
Back in the day.
I mean, hopefully it's not 17 grand a roll wallpaper, but yeah, I mean, I mean, he's back to acting with just complete impunity, and the markets love it, right? Because when you actually look, I did read one liner in a piece we might get a chance to talk about from a guy called Rich Excel, where he said there are no conservatives left in Washington DC.
Ah, dear.
It's just throw money at it, dress it up as helping everybody. And
yeah.
So, yeah, interesting times, eh?
Right, let's go in. We got to take a look at Bitcoin, don't we? We're going to do that in overnight action. It really did feel like the pressure was there on the upside. Is that a round of applause for Bitcoin or for Scotty, or what's that random?
For everybody.
Up and away. It took a second leg up at 5.4.
I'm doing well, all things considered. Looks like we had some spicy headlines over the weekend, but I don't think the markets are going to care in a few minutes.